Paul. This is block week 2. So it's the block week at the end of the second term, end of the first semester. And this is property economics and finance 3. Okay. What we're going to cover today, there were a lot of disruptions in the second term of the year. So we didn't get through as much work as we wanted to. We didn't cover as much detail. But what we're going to cover today, we're going to go through Unit 5, which is investment strategy. We're going to go through Unit 6, which is ownership entity. Then we're going to have a break. And then we're going to do, Unit 7, which is tax. And then what we'll do is we'll close off by discussing the exam. We'll just discuss the exam in a little bit more detail. I'll give it a broad sort of outline of what the exam is going to involve, and I'll place it on Blackboard. But we'll go into a little bit more detail about the exam. Okay. So, Unit 5, investment strategy. Unit 6, the entities in which you own the properties. And then Unit 7, we're going to close off with tax. Now, with the property as an investment, like any investment, one needs a clear strategy. One needs a plan, one needs a strategy. One needs to get some idea of what you're looking for, what type of property you're looking for, or and what you intend doing with it. Okay? Do you intend occupying the property yourself? Do you intend renting the property to earn an income? How long do you intend holding this property? And then ultimately, and what sort of return are you looking on this property before eventually you dispose of it? And the reason why it's so important, especially as an investment, is that if it doesn't go well for whatever reason, tenants might not pay timeously, the economy might go into a slump, the property market might go into a slump like, for example, it did in 2008. You've got to have a plan, you've got to have a strategy of how you're going to deal with that particular situation. And if it goes beyond a certain value, that you have an idea of what you're going to do with this property. Are you going to dispose of it, or are you going to hang on a little bit longer? Because if things really turn awry, you can lose a lot of capital. Okay, so it's very important to have a plan in place. Now, I was looking at, yesterday I was having a look at LinkedIn, and there were a couple of articles there that the Harvard Business Review posted up. So I just want to read a little bit of it. Okay, the first one is effective leadership teams have clearly defined charters. They narrowly focus on the most strategic priorities and don't detour from them. So this whole thing is about having a plan, a strategy in place, which is very strict. You've got to be disciplined to sit with this plan, okay? And you don't detour from it. As soon as you detour, it becomes problematic. But if you do detour, you've got to have another plan in place. And you've got to have a reason why you're detouring. You know, if you've got shareholders, if you're a property fund, for example, you've got shareholders, they're going to ask you questions. Because if you do tend to detour and things do go awry, they're going to approach you for answers. Okay. So this is particularly true for property funds, for example, that look to outsiders for capital. They stick to well-articulated decision-making processes, and they intentionally transfer their disciplined focus down right through the organization. So everyone takes on the same responsibility. Okay. Another one I saw there, also from the Harvard Business Review. Leadership teams must operate as a unified force. So you must all have the same ideas, or very similar ideas. You know, you go to an old company like old companies like Sanlam or Old Mutual that have been around for forever and a day. They have very conservative views on investments, and they generally have maintained the same views right through the decades. Okay, and managers and CEOs, they've come and gone, but yet the organization has remained very unified and remained carried on along the same path. Shared goals must be accompanied by shared accountability. High-performing leadership teams, they say, are 5 times more likely to hold members accountable for shared goals than their low-performing counterparts. So you've got to have, and we've seen in the last, 6 to 12 months, in the run-up to the elections, some horrible things that have happened around the country, you know, in terms of businesses, in terms of certain government departments, the way people have run away from being accountable for their actions, you know. Okay. And this must permeate right through the organization. Okay. Just to give you an idea of what can happen if you look at over time, and you look at the price or the value of the property, price or value. You know, if one purchases a property at a particular time, at a particular value, it's lovely if the capital value of the property increases over time. And sometimes it does. If you had bought in the Western Cape in 2002, you could have held that property for probably up to 7 or 8 years. But typically, some of these funds hold for a period of 5 years. You could have held that property for 7 or 8 years, and you would have seen continued growth, and you would have done exceptionally well. The problem is, if you'd bought property in 2016 in the Western Cape, you wouldn't be looking so pretty. Okay, so property has come off quite dramatically in the last, probably 20 to 25% in the last 2 years. So one must make provision for these downswings, and you must have a plan as to what sort of loss or what sort of turn you're going to accommodate. Okay, and once it reaches that point, then you've got to make decisions whether you sell the property or whether you carry on maintaining it. Okay. The other thing is, over time, is that properties deteriorate. Okay, and they need refurbishing and rebuilding. And typically, the value of the property actually does do this. So one needs to maybe, you see with shopping centers often, what they do is they recycle the shopping center. So this type of thing happens. They do a refurbishment, and then we start seeing some growth again. We're seeing that, I don't know if any of you are from Johannesburg, but if you've driven around Four Ways area, the Four Ways Mall is currently going a major upgrade. And I think that upgrade is taking about 2.5 years to complete. And it's so comprehensive. They've got roads coming off major in routes and got roads going onto these routes. So they've created these bridges and to approach the parking areas, and so it's a major upgrade. It's almost like similar to what Sandton City has. So they probably found that they were starting to hit somewhat of a decline. In fact, if you visited the place, it started looking a bit tatty. And now they're upgrading it, and we'll probably see growth for them after that. Okay. Now, in the book, I'm not terribly sure the page. I know it's Exhibit 5.3, and I actually posted it. I posted it on Blackboard, and I want you to have a look at this thing very closely. It's called the investment analysis process, and it's basically a 10-step process that illustrates the logical steps an investor should take. Okay. And you'll notice that it gives you an out. Every single level gives you an out. If you get to a certain point and you're not satisfied or not happy with the performance or the information you've gathered, then you can pull out of the investment and look for something different. Okay. And the investment can be dropped, and you can maybe find some other investment. What's quite interesting in this, I don't know if you guys have got it in front of you, but what's quite interesting is if you remember when we did net present value, which is a very important part of the first semester. We did that towards the end of last quarter. You can see that within this the structure, that is only done in item 7. So this is a 10-point process. In item 7, that particular function is performed. So it's a hell of a long way down the line before you perform that sort of more concentrated or involved analysis. But let's take a look at this 10-step investment analysis, and I would encourage you to actually know this for the exams. I'd encourage you to know it and to also not only know the points, but to be able to talk around the points as well. So let's talk around it. Let's go through the analysis, the structure, the process, and chat a little bit about each point. So first off is what this chapter is about, and we'll get to the different points in investment strategy just now. But the first point you see there is develop or determine your investment strategy. Okay, so you can see it's very important. Right up front, you've got to know what the philosophy of the firm or the partnership or the individual is. Okay? You've got to know what your objectives are and what your investment criteria are. What are you looking for? Are you looking for a rental? Are you looking for capital growth? What sort of return are you looking for? Are you looking for 10%, 8%, or are you looking for more, something more risky, like a 12 or 15% return? And then you must have plans in place, and you must have basic screening criteria. So, generally what happens is you approach an agent, and you'll present the agent with an idea of what you're looking for, and the agent will come back to you with a number of options, and you must be able to sift through those options and be able to narrow them down to a couple that you can look at more seriously. Okay, so there's at point number 2. You generate alternatives. So this is where you probably use an agent. You might have in-house, if you're a big firm like the likes of these property funds, you've probably got a department that does this. And they go and locate properties that meet the basic screening criteria. Okay, so you've got the screening criteria in place, so that they know what type of building you're looking for, or what type of property you're looking for, and they know what sort of return you're looking for, so they can go and have a look at what sort of return you can achieve from a property like this. So you locate properties that meet your basic criteria, and then you collect some preliminary data for analysis. Okay. But remember, still, we are a long way from item 7, which is the actual net present value. And then we get to point number 3. Yeah. Come again, what kind of? Oh, it would be maybe the location, maybe the size, or the price maybe the size of the property in square meters. If you're looking for office accommodation, maybe some details about the office accommodation. So just some basic criteria about the property to make sure that it actually fits in with your criteria. Location would be a very, very important one. And I suppose, when we'd be looking at maybe parking facilities, if it's a shopping center, you want to look at parking facilities for sure. Closed, open, and a number of shops, for example, and how many big shops are available. Maybe you've got one or two supermarkets that might be interested in being tenants of yours. Yeah, so some basic criteria. So you wouldn't start looking at major figures yet. That comes a lot later. Okay. And then you do some feasibility studies. You'd look at you'd analyze some basic economic returns. You'd analyze some different financial packages. You'd have a look at how you're going to finance this thing. Do you have sufficient capital for this particular property, or would you need to borrow? And what sort of rate would you pay on loans for this particular property? And every single property will have a different structure in terms of the way it's financed. Okay, and then you get to number 4. You'd negotiate basic terms with the seller. So, say for example, you've got 2 or 3 properties that you're looking at seriously. You would go to the sellers and you would negotiate basic terms. What sort of price are you looking at? So you can get some idea where you can start the bidding process. They'll show you an offer. You'd then be able to get some idea of what you're going to pay for this. Okay. And that'll become very, very important when you start looking at item 7 when you do your net present value. Okay. Because then you'll know exactly what this property is worth and where you can start bidding. So when you negotiate these terms, you'll get the price. You'll be able to also negotiate maybe with the banks if you're looking at loans to find out what sort of financing terms they can offer. And a very, very important thing we'll discuss a little bit later in Unit 7, tax. Tax is a very, very important consideration. So with tax, you've got to find ways of minimizing your tax exposure. And the different entities you can use, ownership entities in Unit 6, are very important. And we'll go through what the tax rates are for the different entities. And one must be aware of how you'll be taxed going forward. And if you can minimize that exposure, that's in your favor. So you should be looking at maybe different tax considerations there. You then go into, and you can see at any point here, if you're not satisfied with a particular property, you can remove it from your list. Okay, so you're going down this process, and at any point you can start removing, and you'll start eliminating, and you'll eventually probably get down to 2 or 3 properties that you're going to look at. And then item 5, says you do more detailed feasibility research. You start doing some market analysis. So if it's a shopping center, you start looking out there to see what sort of tenants you'll be able to use in the building. You might be able to use the current tenants, but you might have to look for other tenants. So location there for a shopping center or for an office block is very, very important. Okay. You do a physical structural analysis. That's very important. You probably get an engineer in to have a look at the actual structure, to have a look at the building itself, to make sure it's sound, and to make sure that there are no major problems with the building. And if there are, then what the cost will be to actually rectify this thing before you start bidding. You must know what sort of cost you're in at the end of the day before you can start utilizing the building. So you do a physical structural analysis, very important. You look at the environment, I suppose. You look at the area and how the area is going to develop over time. What sort of development is coming into that area. For a shopping center, that's very important because it's traffic that you need through the shopping center. So if a new township is being developed in the area, then that's very, very positive for a shopping center, for example. If you're looking at a building in a city, you look at what sort of developments are happening around the city as well. You look at the management of the building, the current management. Okay. Then you move on to number 6. And here you do a more complete financial and tax structuring. So you can get ready for having a look at item 7, which is the net present value. So now here you're looking at what you prepare to pay for this building. You've got a fair idea of what you're going to be prepared to pay for it. You've got a fair idea of what sort of income you can generate in terms of rentals. Okay, you'll need this for item 7, so you're gathering all this information together, and you're looking at how long you're going to maintain this building. Are you going to have this building for 5 years, or for 7 years, or for longer? Okay, because we need that in item 7. If you remember when you do your net present value, you need your purchase price, you need the term that you're going to hold it for, and you need your sale price. And during the period, you need your income, your rentals. Remember that from the net present value. You need your purchase price. Remember, we always stuck to 3 years. So let's look at a 3-year outlook. So you need your purchase price. You need your selling price. Okay? So you've got some idea now of what you prepare to bid for this building. You know what they're offering, what they're asking for the building. You've got some idea now of what you prepare to pay for this building. You've done your sums. You've had a look at the structure. You know what changes need to be made, what repairs need to be made. So you've got some idea of what you prepare to pay for this building. You also have some idea of given what the market trends look like over the next 3 years, what the economy looks like, you've got a good idea what sort of return on your capital you can achieve over a 3-year period. You buy this thing for R1 million, you know that, you have a fair idea, you've done your calculations, that over 3 years you could probably return 1.2 million. Okay, so a capital appreciation of about 200,000 rand. Okay, so you have a fair idea of this. Okay, so you got the period, and then what you need to do, you need to be able to ascertain what sort of rentals you can achieve in this building. And that's through that market research that you would have conducted. You might be looking at maintaining some of the existing tenants, or you might be looking at other tenants. So you'll be doing some sort of market research. You might have done a little bit of, you might have done a few negotiations with some big supermarket chains as well. Okay. So you're gathering all this information because in item 7, it's very important. That's when you do your you do your net present value calculations. Okay. And in item 7, when you do these net present value calculations, you evaluate your risk. So remember, you're discounting when you're doing this calculation, you've got a discount rate. And that discount rate is a reflection of what risk you're going to take on. Okay, so if the discount rate is 12 to 15%, it's generally fairly high risk. If the discount rate is 8%, it's fairly low risk. Okay. If it's around 10, 11%, it's generally sort of medium risk. So depending on what your risk profile is, you'd be looking for buildings in that area. And then depending on what the risk of the particular building is, you would provide a discount rate. Okay. So that discount rate is a reflection of the risk that you think this building is going to provide. And then you perform that particular net present value calculation. At the end of that, you've got a very good idea of which of the 2 or 3 buildings gives good value. And from the examples that we've done, that you get a net present value, and the one with the highest net present value is the one that is going to provide the highest return. Okay. So then with that calculation, you'd go into item 7, and you'd go and do your final negotiations with the seller. Now you can probably adjust you might want to adjust your purchase price a little bit, and you'd go into negotiations with the seller. Item 9 is managing the property through the 3-year process, and then so you'd manage the property through the 3-year process, and that management entails a number of things. It entails not only collection of rentals, but it entails the actual management of the property, the physical property, the accounts, the tax, etc., the reporting, all those things. Okay. And then finally, we'd get to this point here where we terminate the building. Okay, so that process is very important. I'd like you to go through that in detail and understand, know what the 10 points are, and be able to explain broadly each one of those points, just like we've done now. Okay, you don't have to remember every single point there, but just be able to broadly explain what each point is. Okay, so it's not a situation where you go and sit there and you write the 10 points down and you learn them off by heart. That what you should be able to do, it should be a process that comes naturally, and you think about it and you go through the process in your head. You say, well, okay, item 1 is this, item 2 is that, item 3 is that. If you don't get in the right order, it's not that important. 1 or 2 out of order is not that important. As long as the 10 are done. The last 3 are very simple. You should be able to remember those very easily. Net present value, it's the management and the termination. That's very simple. Some of the others you might have to just think about a little bit. But very important, and very important for the examination. Okay, so have a look at that and make sure you know those 10 points and you are able to talk a little bit around, maybe a sentence around each of the points, that we can see that you understand it. Okay. Are there any questions about it? So that you can see is Exhibit 5.3. I'm not too sure the page. Have you got the page in the book that it's on? 117, page 117. So if you've got the book, it's in the book on page 117. Otherwise, there it is on Blackboard. Okay. Okay, so in that process, you see item 1 is determining an investment strategy. Okay, so first off, when one develops an investment strategy, one must have an investment philosophy. Okay? An investor should decide what the nature and the degree of his involvement in real estate should be. Okay? Is it a direct involvement or is it an indirect involvement? So direct involvement is you as an individual or you as a firm buying the property. Okay, so you're directly involved. Indirect involvement is maybe buying real estate investment trusts or buying shares in a trust, a property trust. And those you can do through the JSE. They have their advantages, they have their disadvantages. Okay, but they have real estate investment trusts have a lot of advantages. For a very small amount of money, the most important one, for a very small amount of money, you get exposure to a diversified portfolio. So you've got to think, are you going to be directly involved in property or indirectly? As an individual as well, you might decide that you don't really want to own property directly, you don't want to own a home, you'd rather rent, and you'd rather put your capital into something indirect, where you've got experienced and well-qualified managers doing the management of your money. Okay. They guys, I mean, if you read, I also read something on LinkedIn the other day where so many, it's about very wealthy people and how they've lost their money. And what happens with very wealthy people, generally what happens with very wealthy people, they become quite arrogant. So if they've made a lot of money somewhere along the line, it could have been a hand down, or it could have been they could have made the money themselves. And they've made the money in a particular area of work. It might have been selling motor cars. It might have been selling houses. It might have been lotto, actually. Could have been anything. They then think, because they have now made this money, they now are able to make money in any area. And they seem to acquire this general knowledge of everything. And what happens is they then take their cash and they start investing it across the board, and they start making horrible mistakes. Because every single investment carries its risks, and every single investment is different. So if you're investing in property, or you're investing in shares, stocks, shares on the JSE, and they could be different shares. They could be property. They could be mining. They could be financial. So one's got to look at every single one and take its case separately. So generally what these people do is they invest across the board, and they think because they've done so well here, they're going to do well everywhere else. And generally they actually fail. So it was quite an interesting article. So do you get involved directly or indirectly in property? So you've got to decide that. You also got to decide on the time that you want to be invested. If it's going to be a home, it's generally quite a long time. If it's something like this, like a property as an investment for like a shopping center or a building, you might be looking at a short period of time. Funds generally look at between 5 and 10 years. Some a little bit longer, but generally between 5 and 10 years. Okay? And then you've got to decide on what your role is. Are you going to be very involved, or are you going to look for others to take on some of the roles? So you might decide that you're going to purchase the property, but you're going to look for a management agent or management company to manage the property during the period. And there are lots of those available, where they will make sure that the rentals are collected, and they'll make sure that the property is maintained. And if you don't have the time for that, then maybe you should be looking at someone to take that role. Okay. Okay. So first off, you've got to decide on what your investment philosophy is. Okay. Secondly, you've got to decide what your investment principles are. So we give an example that we say, should it be a diversified portfolio, or should it be maybe a single property? And what sort of risk are you prepared to take on, and what sort of return you're looking for? So what are your basic principles? And thirdly, we look at your investment objectives, your goals and objectives. Are you looking for a regular return? In other words, are you looking to rent the property? Are you looking for tenants? Are you looking for this property for your own use? Are you looking for capital gain? Are you looking for this property as a provision for retirement? So what generally happens with older people, they buy properties to earn an income that helps build up their capital for retirement. And are you looking for estate building, tax shelters? So there are a number of points that you can look at. So what are your investment objectives? Why are you purchasing this property? For what reason are you purchasing this property? Okay. And then the next point, the fourth point, is decision criteria. The objectives specify exactly where the investor is going, what you're looking for. The criteria indicate where the objectives, when the objectives have been reached. Okay, so in other words, you would have set the criteria would be I'm looking for a return of X, or I'm looking for a capital gain of X. Once I achieve that, then I'm going to terminate. Okay, or I'm looking at holding this thing for 5 years, irrespective of what happens in terms of the return or the capital gain, and then I'm going to terminate. So what are your criteria? Okay. The next one, the fifth one, are your plans. You should have a detailed plan, step-by-step procedure of achieving your objectives. So you have these objectives, and you have to have a plan in place to specify how you're going to, a step-by-step plan in place to specify how you're going to achieve this objective. Okay, so if it's a building that you're going to hold over 3 years, what are you going to do from year to year to make sure that you achieve the return you want over the 3-year period? The next point, the sixth point, is screening criteria. So you specify basic screening criteria. We discussed that a little bit earlier. The next point, decision-making biases. One's got to be aware of these biases. So decision makers are generally or subject to all kinds of biases and can make irrational decisions. Okay, and there's an example there. Often investors think that they know more than they do. So I've given this example now where guys have made a lot of cash in one particular area of their life, and they think that they have information about all areas, and they get involved in other areas and they start losing their cash. So that would be deemed a bias. Okay. So one's got to be careful of these biases. Okay. So that's just a couple of points there for developing an investment strategy. Are there any questions about this? But if you have to take anything out of this unit, Unit 5, I would be looking at that 10-point process. It's a fairly structured process. It gives you a good indication of what sort of flow you should be looking at when you're considering buying a property, and how a couple of the chapters or a couple of the units that we have discussed or will be discussing fit into each of those or fit into this particular process. So instead of just studying each of these units, you can see that they do actually fit into some a process along the way. Okay, any questions about Unit 5? Okay, let's look at the next unit, Unit 6, which is ownership entity. Now, we didn't spend too much time in the lectures on this particular unit. I think we spent a week on it. So for the part-time students, they would have had one session. And for the full-time students, they would have had 2 sessions on this. So it's a fairly brief unit, but all the same, it is very important. It's very important to know up front what sort of entity you're going to use to acquire this investment or this property. Are you going to acquire it in your own name? Are you going to acquire this in a partnership? Are you going to acquire this in a company? Or are you going to acquire this in a trust, property trust, or a family trust, for example? They all have their benefits. They all have their shortcomings. Some of them provide a certain amount of protection. That's a very, very big plus factor for some of them. Protection from creditors. So trusts are used quite widely. Family trusts are used quite widely to protect assets or capital from creditors. And then the other thing is the tax considerations. Each one of those entities has different tax criteria. And remember what we said initially, one must try and minimize your tax exposure. Okay. So up front, one must be aware of what you're trying to achieve when you purchase this building. And if protection from creditors is a very important aspect of what you're doing, then maybe a trust is the right vehicle. But then one must be aware that the tax of a family trust is a lot higher than other entities. So, okay. So some of the criteria which impact the selection of the ownership entity, I've mentioned a couple, but let's have a look at them here on the list. Tax. Tax is a huge one, very, very big one. Especially when it comes to capital gains. We'll see when we discuss the next unit, Unit 7, tax. Capital gains is a big, big thing. And you'll notice that the effective tax for individuals, effective capital gains tax for individuals is a lot lower than the effective tax for family trusts, for example. So that's a big consideration. We're trying to, given our intentions, we're trying to minimize our tax exposure. The second one is limited liability. Are you looking for limited liability, or is that not a major criteria for you? Limited liability means that if you are looking for that, then you'd register a company and you'd buy the property in the name of a company, or you'd register a trust and you'd buy the property in a trust. There you have limited liability. Whereas if you register the property in your own name or in a partnership, the liability is not limited. Marketability and transferability of interest. So yeah. Yeah, it would be, because each entity carries different tax criteria. Yeah, so it could be, yes. Yeah, as I say, like for if you look at registering a property in a person's name, you don't have limited liability, but then you do have the advantage of the tax in terms of capital gains, and we'll have a look at that just now. But if you register in a trust, you do have limited liability, and you also have protection from creditors. But then you have the heavy capital gains tax, effective tax. So, yeah. So marketability and transferability of interest. So also, it's a bit of a tax consideration, because if it's registered in your own name, then you need to transfer it away from your name, and the purchaser must pay a transfer duty. Whereas if it's registered in a company and you sell the company as a going concern, all you do is you change the shareholders, and there's no transfer duties payable. Okay, but it has to be sold as a going concern. Okay. Management control and expertise. So, yeah. No, you can sell a company. You can sell the assets out of a company. You can sell the company if you want to avoid the transfer duty. It's got to be sold as a going concern. It's got to be say for example it's a restaurant, and the restaurant owns the actual building itself, and the buyer is interested in buying the restaurant to carry on the business as a restaurant. Okay, not necessarily maybe under the same name or maybe serving the same type of food, cuisine, but definitely carry on performing the same function. Then you can avoid transfer duty. But if you're buying that building and you're going to use it for something different, then I think you're in a battle to get away from transfer duty. It's got to be sold as a going concern, and it must carry on doing a similar business. Yeah. Otherwise, I think transfer duty is payable. But we'll come to tax just now. Tax is a very, very complex subject, and that's why people spend 4 to 5 years studying this thing, and their whole lives, maintaining their knowledge. It's an incredibly complex subject, and there we were trying to finish it. We'd do it in 2 weeks, So it's a very complex subject. We'll discuss it in more detail when we get there. Management control and expertise, very, very important. Do you want control of this property? Do you have the expertise to control this company and to maintain it? If not, maybe you're looking at investing your capital in a trust, like a real estate investment trust or a listed property trust. Okay, then you'd have no control. You'd be passing your capital over to a third party. They would provide the management. They would provide the expertise. Okay, so what are you looking for? Are you looking to manage it yourself, and do you have the expertise to do so, or are you looking for someone else to do it? Okay. Continuity. Continuity. Good one. Not too sure what they mean by continuity. Because generally, if you buy a property, you are buying something that remains in your name until you actually sell it. Maybe it's a closed-end fund. Some of those closed-end funds are the period is actually specified. It might be a 5-year or a 7-year fund. So maybe they're talking about that. And at the end of that period, the assets are actually disposed of, and you get your capital back. Degree of privacy, favorable public image, government controls and reporting requirements. The government is always an important aspect in any purchase you make. What's sort of happening in the environment, what's happening around that particular area, are there changes that are going to happen, are there changes happening? Right now over the last couple of months, and particularly now going forward once the elections have been completed, this whole thing about land is going to be an issue. So that's a very important thing now if you're buying property, a consideration, yes. Capital outlay requirements, how much capital do you need to make available, and how much are you able to get in terms of a loan? Diversification, so if you're looking for something diversified and you don't have a lot of capital, then those real estate investment trusts or property trusts are brilliant. If you're looking to create a diversified portfolio yourself, then you're looking to buy a number of properties. Okay, a number of properties in different geographical areas, different types of properties. Okay, so to narrow your risk. Regularity of return. How often do you need a return? Sometimes people buy land, and all they're looking for is a capital gain over 5, 7, 10 years. Okay, so there's no return during the period. There's certainly costs, but you're looking for a capital gain at the end. If you're looking for a monthly return, then you're looking for maybe a house, a set of apartments. You may be looking at an office block where you're getting regular returns, monthly income, or you might be looking at a shopping center. Okay. Estate building, that's if you as a person are building up your estate. And generally when people get a little bit older, what they tend to do is lower their risk profile, and property is normally a good vehicle that has a fairly low risk profile, and they invest their monies in property, and they receive and they rent them, receive income, and in that way build up their estate. Retirement fund, same thing. Okay. Now, every single one will have its advantages and disadvantages. And one needs to decide which of those criteria are most important to you, and then go out and seek the type of entity that would satisfy those criteria. Okay, so first of all, you've got to know what your criteria are. What are the most important criteria? And then you go and look for the entity that actually is favorable. Okay. So then we've got a list here of the type of ownership, types of ownership. So first of all, you have freehold. Okay, the first type of ownership is freehold. And freehold is basically if you're an individual or a company or a trust, and you go and buy the company in the name of that, or in your own name, or in the name of the company, or in the name of the trust. Okay. So, or it could be a partnership actually, but that entity actually buys the property. The second one is a joint ownership type structure. The negative side of this, so all the names get registered against the title deed, okay? And the title deed will reflect the share of the property that each investor enjoys. But the negative side of this is that each can dispose of their share without notifying the other party. So in other words, you might have come together as a group of individuals, and you might be like-minded individuals, and you might have got together and said, okay, these are the criteria that are very important to us. Okay, let's set up this joint ownership. We buy this property, but 3 years down the line, one of the individuals runs into financial difficulties and needs to bail, and they sell their share without notifying the others, and they don't need to notify the others. And they sell the share to somebody who's unscrupulous or whatever. It can have a negative effect on the ownership of the property down the line, or the management of the property down the line.
With such drawbacks, what would be the reason to have something like this? I mean, already you can come together as a group and decide on one thing, and during the course of time, somebody decides to do as they wish, like say introduce somebody that could be unscrupulous to the whole thing. What's still the use of having something? To me, it's not worth having this kind of ownership.
Yeah, I think what is the what's the advantages
Of joint ownership? Interesting question. I think that the main advantage is possibly a capital one, that you don't, these group of individuals might all be wanting to get or expose themselves to. I remember in 2002, I came down here with a venture to have a look at property, and it really was the right time to get involved in the Western Cape. It was glaringly obvious. It just was staring in the face. And funny enough, the process started here and actually moved up the East Coast, and then went all the way up to KZN, beyond Durban. So it was a process that started here in 2002. I can remember it hit the Eastern Cape around about Plet, Knysna, Cape St. Francis around about middle 2003. So you can see it's quite a slow process. And then probably got to KZN around about 2004 sometime. But I remember we looked at Camps Bay. I mean, you can hear this one, eh? In Camps Bay, there were down at the bottom where the hotel is and the main road is and the beach. Just behind the hotel, there are a whole lot of houses. And I'd say they're probably 3-bedroom, 1-bathroom. They're very old places that were built maybe in the 40s and the 50s. And we looked at those properties, and we looked at maybe acquiring 50 of those properties. And you could get them for R1 million a time at the time. I mean, I don't think that you could get those things now for less than 7, 8, 9 million, just because of their location, because that is a place to be. So but the growth actually happened between 2002 and about 2010. But even if you'd held them for 5 or 7 years, you would have had huge capital appreciation. Anyway, so this money was, the funding was going to come from an overseas fund. It was a European fund. And then we had the Zim elections end of 2001. And this fund, these guys in this fund took fright, and they actually withdrew their commitment. So we'd done all the groundwork on this thing. We'd negotiated all sorts of things, and the funders actually ran away. What I did, I thought, I can see this thing is so obvious. I still want to try and get involved. So I actually made a couple of trips overseas. And what I try to do, I try to put something like this together. So it was, with the original situation, we had all the funding in place. They were going to provide a lot of money. They were going to provide something like 400 million rand. So 400 million rand in those days was a lot of money. And we were going to do a lot of things in terms of property. So I ran around trying to find 50 million rand. And the best place was overseas, because at the time, the rand was trading 11.5 to the dollar. Okay, it's worse now, but at that time it was very weak. It was relatively very weak. So I thought it best I go to Europe, all the States, and find this funding. So I was looking to set something like this up. So trying to find a number of investors who'd be interested, and setting up some sort of joint ownership. So I think that is the main advantage, where one particular individual or one particular entity cannot take over the full investment, or doesn't want to take on the full risk. So you want maybe 5 or 6 guys or businesses to get involved and provide 1/5 or 1/6 of the capital. Okay, and also take on 1/5, 1/6 of the risk. So it's providing the capital and also the risk, taking on the risk. I think those are probably the most important things.
What's the difference between this and shares in a company?
Yeah, okay, well, a company's somewhat different, because a company has limited liability. This is something different. This is almost like a partnership. But a partnership is a little bit different, where you have to let your partners know. I think they've got to have first right of refusal. I think in a partnership, this is slightly different because you don't have that in place. But this is not limited liability, because you can see that each individual's name is registered against the deed. So a company is something different. A company, if you've got a private company, you can have up to 50 shareholders. If it's a limited company, you can have endless shareholders. So, company is completely different.
Yeah, it's completely different, but wouldn't it be better to buy it in a company and have 10 shareholders than have 10 divided shares?
Well, then you're looking at the tax issue. So we'll look at the tax thing. Your effective capital gains tax as an individual is much less. I think it's like 13%, as opposed to your effective tax for a company is something like 22.4%, and for a trust is 36%. So if you look at a trust, let's go for the worst case scenario. You look at a trust, and we will discuss it just now, but you look at a trust and you hold a property for 5 years, and say you've made 300,000 rand on that property. Your effective tax rate on that capital gain is 36%, which is about 1/3. So you have to give away 100,000 rand of your capital gain. So you walk away with 200 and not 300. So you're giving that to the government for taking on absolutely no risk. You've taken on all the risk, and they walk away with 1/3. And the reason why it's so high is because they're trying to make those family trusts unpopular. They don't want them. So they make the tax that much higher. So it becomes, so you've got to think about, first of all, your criteria. Okay, so if tax is a criteria, then maybe you would have chosen this joint ownership. Tax is not a criteria, or it's not as important, and limited liability is more important, then maybe you'd go for a business structure, company structure. Okay, so it does have its place, yeah. So, to finish that story, sorry, I couldn't find the investors. I came back here with my tail between my legs. I was very, very sad. And funny enough, in about 2005, once it had all happened, there was this Middle Eastern fund that came through. They'd heard wind of this, and they wanted to get involved. And I said, it's too late. It's gone. It's finished. So I had to turn them away. But and they came with more funding. So, but anyway, I mean, if you can't see the capital growth, then you can't commit somebody to it. Yeah. Sorry.
So I was going to say, if you buy the property through a company, you obviously have to pay capital gains tax when you sell the property.
Well, you buy a property now, doesn't matter what the entity is, you've got to pay capital gains tax, even as an individual. So as an individual, you get, and we'll discuss it a little bit later too, as an individual, provided it's your primary property, it's the one you actually live in, you get you're allowed the first 2 million rand free. But for most people, to make a capital gain of 2 million is not going to happen. So generally, with your primary property, you don't pay capital gains tax. It's only for the very wealthy. So beyond 2 million capital gain, they'll pay tax on that. But if it's your secondary property, so a lot of people have second homes. They have a home at the coast, or they have a home in the mountains, or some people do have, or they have a rental property, for example. You'll pay full capital gains on that if it's registered in your name.
Where I was going was, at the end of every financial year for a company, you have to pay tax if the company is making profits.
Income tax, yeah, that's income tax. Yeah, that's
So if the company is making profits, you have to pay tax.
that's income tax.
So
Yeah,
that would include the monthly rentals of the property.
that's right.
Letting the property
Yeah,
out.
yeah,
Just like when you are an individual, if when you getting rentals, monthly rentals,
Mm.
at the end of the tax year, you have to declare that you have this property that you're getting rentals.
that's right.
So you have to get taxed on that.
You do. Yeah, it forms part of your income. Yeah. So in other words, if you are employed by, say you're employed by a property company, and you're an agent and you receive a salary, say you receive a salary of 10,000 rand a month, you'll pay tax on that. You'll pay income tax. Okay, it gets deducted before you receive it in your bank account. If you have a rental property and you're receiving 1,000 rand a month from that every month, at the end of the year, you've got to disclose that income in your tax return, that 12,000 rand, okay, 1,000 rand a month, and then you can deduct certain expenses. Okay, there's maintenance, there's finance costs maybe you're financing it. There's a couple other costs. You might have the rates will come off. So there are a couple of expenses you can actually deduct, but then the net amount you'll be taxed, you'll pay income tax on that. We'll have a look at it in the next unit. Yeah. Okay, so that's a joint ownership. Quite an interesting one.
So on the joint
Yeah.
ownership, sorry, it's just that I have a friend of mine who is in a joint ownership property with the then boyfriend, and now the boyfriend is not paying. It was a bonded joint property. So now she's left alone to take over the property.
Yeah, that is a problem.
Yeah.
So that's a problem in the partnership as well. So you're joint and severally liable. So in other words, if something goes wrong with one of the individuals, you can ask them to maybe sell their share. You could buy their share from them, or you can maybe. And in fact, the best thing for her would have been to have a written agreement up front. These joint. I suppose that's also an advantage with a joint ownership, because you might not know the individuals. You might not know them very well, but you'd certainly sit in front of a lawyer and you draw up a contract. The problem with a partnership, generally what happens between partners, and maybe if you're married, you might put it in both your names. Generally what happens there is that it's an agreement that you have, a verbal agreement. You don't actually go and write something. And you both put capital into this thing, and you both pay off the bond. You're both paying towards the bond, servicing this bond. And then one actually so-called reneges, or just can't make it, or can't pay it. Or you have a breakup, you separate. If it's not actually, if it doesn't sit in a document, how do you actually deal with this? It becomes an emotional thing, doesn't it? It becomes very, very complicated. So the best thing, if you go down that road, the best thing is to sit in front of a lawyer and actually draw something up. Because often relationships go awry, You might have an argument, you might have a fallout. I mean, it can happen. And if you have assets together, you must have a way out of these things. Has she got an agreement in place, a written agreement? Yeah. What normally happens is that, when you fall in love and you make those sort of emotional decisions, it's quite easy to make them. But, when you get to the point where it all falls apart, it actually it gets very, very nastier. It's not a good idea. Well, who knows? Leasehold. We all know what leasehold is. It's basically renting a property from somebody. So you're leasing the property from an owner. Could be a residential property, could be an office block, could be a shop. So you're leasing it. You don't have ownership of the property, but you enjoy virtually the same benefits as the owner. Okay, while you occupy the property. Okay, and you've got certain responsibilities as well. You've got to, and they're all set out in a document, and that's called the lease agreement. It's all set out there. So you've got to adhere to those requirements in the lease agreement. One of which is paying the rent. Others that are there are maintenance. You've got a certain responsibility towards some maintenance, and also towards notifying the owner of maintenance problems. The next one is a company. Here there's perpetual existence and there's limited liability. So limited liability is the most important one here in terms of a company. Okay. And remember, with a private company, I think the shareholders, the limit is 50. If you want more than 50, you register in a limited company. Share block companies, they're controlled by the Share Block Control Act. So this offers the possibility of more than one investor investing in a single property. Okay. There are a lot of those around. They generally, you generally find them in blocks of flats. Sometimes you find them in office blocks. They're registered under this piece of legislation. Syndicates. That's very similar to a partnership, but it's more of a business relationship. I remember there were investment companies used to run syndicates in the past, and they gather funds together and they invest these funds in property in the name of the investors. Usufruct is similar to a lease. Sectional title. That is where each owner has exclusive ownership of a particular unit, and then you have common property in the establishment. Those are normally the gardens, the drives, the parkings. Sometimes you have exclusive use of some common property. You might have a particular parking allocated to you, but also a lot of the blocks of flats are sectional title. Trading trusts, property unit trusts, real estate investment trusts, they're all quite similar, and we'll see that when we get to tax, what negative aspects they carry in terms of tax. They do real estate investment trusts are particularly good for investors. They provide diversified portfolios at a very, very low capital outlay. They have professional management, which is very important. they're also subject to demand and supply, and the prices are always available. The only negative thing about a real estate investment trust, they're exposed to two risks. They're exposed to property risk, but they're also exposed to market risk. Now, market risk is exposure to market risk is because they're listed on the JSE. So if, for example, there's a market crash, then generally all the shares come off, irrespective, and property shares will come off as well, irrespective of the value of the property. Okay. So real estate investment trusts are exposed to both property risk and also market risk. Institutional portfolios, these are generally used by big institutions like Old Mutual and Sanlam. They'll have different vehicles that they might use to buy properties. And the last one is equity funds. Yeah. Okay, I think the most important ones are the freehold, the joint ownership or partnership, the leasehold, the companies, and share block sectional title. And then trusts, of course, yeah, trusts. So it's important that one knows what criteria one has in terms of what ownership entity is most appropriate. And then you'd go out and you'd choose that entity accordingly. Okay. Okay, any questions?
So the pension funds take the monthly contributions of the...
Yeah, pension funds are registered in terms of the Pension Funds Act, so they can buy and sell assets. They have certain, that's an act, there are laws there, but there are also rules that govern pension funds and how they can behave and in terms of purchase and sale of assets. So they would have special entities in which they place these assets. Yeah. And it's very similar to institutional portfolios, these big institutions. They'd also have special vehicles in which they place these, special structures in which they place these assets. Yeah. Okay. And then you also see that property unit trusts, there's the Unit Trust Control Act. So they're governed by that particular act, and there will be certain laws and rules which they have to abide by in terms of buying and selling assets. Okay. Any other questions about ownership entity? As I say, not a very long section. I think in the exam it's only there's only 5 marks there. When we go through the exam, we'll have a look at, what the area that you must actually concentrate on. But I would say the criteria is the most important thing. So you should know what your criteria are before you decide on which entity you're going to place the property. Okay, guys, I think we can maybe have a break there.